Hello, everyone, and welcome to WeathWise Women with Erin Swenlin and Mary Ellen McGonagle. Welcome to our Thursday, March 12th show. We do have a few stiff drinks on tap for you if you need it, but we also have some comforting chamomile tea as well as we dig into the market in our virtual living room. And hi, Mary Ellen. Speaking of those virtual living spaces and the new virtual work and learning spaces,
Yes.
I'm more thankful than usual that I work from home, but I do have a husband who's a high school teacher, but
No.
fortunately they're going on to spring break for the next 2 weeks, so that should be better. But how are you holding up in the big city of Los Angeles?
Well, I just arrived late last night. I was in New York City last week for the Traders Expo and beginning to question that decision. But interestingly, it really is interesting to me. So New York City, uh, you just would not think that there was any kind of epidemic, now pandemic taking place. Every restaurant, people spilling out onto the streets and just all seemed quite well. And then I came to back to LA, and everyone's just making plans as usual. We're going to go listen to live music. Can't say that I'm going to join my friends, but it is interesting to me to see airplanes mostly full. I was the only one wearing a mask. I even had latex gloves on.
Oh my goodness.
Yeah, I was. But it's just you just have to be wise, just like wealth wise women, right?
Absolutely. Yeah, it's just been a really interesting look, and we've got a lot to talk about today. So let's go ahead and look at our agenda because I know lots of people are tuning into StockCharts TV. And I have to tell you, if you are stuck in the house, if you end up quarantined or however it turns out, StockCharts TV runs 24/7, and we have we have tons of shows backlogged, on YouTube. So
All good intel. So yeah, we're going to be covering a lot today.
yeah. So let's look at, we'll be doing the wisdom of the week. We're going to talk about capitulation because I believe, well, we've hit the definition, but we're going to talk a little bit more about that. We are going to revisit bear market rules. I know people who follow me are probably getting sick of them, but I think they're very important. And, I just think there's a lot of things we can be doing. Of course, we'll finish with, yeah, that happened. But let's go ahead and start with our wisdom of the week. And then we'll talk a little bit about that and maybe look at just some of the current conditions we're experiencing right now. So you're first, Mary Ellen.
You bet. Yes. So certainly there's a lot of questions as far as how to respond to the current bear market period that we are in. Those that have been subscribers to my MEM Edge report, we have been out of the market for quite some time. We would not venture in at this time. There's a set system that can be used, proven system that the bear market has ended. So during this particular period, it is an ideal time to build your watch list. When these bear markets do reverse, they can be really super profitable and very, very powerful. So that is my wisdom of the week. And hopefully we'll have time to share just ways that you can build that watch list and be prepared.
Absolutely. And I guess at this point, I think most people have heard this, but you don't want to try and catch a falling knife, or I have to say in this case, a falling chainsaw. Trying to reach out and start looking for bottoms right now. While you can do that, we really need to get an environment out there that's got less panic injected into it. And so I have to agree with you. The watch list building, that's what I've been emphasizing on my Decision Point Diamonds reports. Of course, decisionpoint.com, you can find them there. But it has been quite challenging to even build a watch list right now. I think that, at this point, looking at those big names, those strong performers, the ones that really seem to have a nice, backstory, that's a good place to be. But it's just been so crazy. I'm going to steal the screen really quick just to give you an idea of the panic that we are looking at out there. This is a the VIX. This is a great measurement of fear. And this is the entire history we have of the VIX right now. And as you can see, we are at historic highs for the VIX. And that is a sure sign of panic and emotion being thrown into the market. There's a lot going on, of course, with with the president talking last night and just how things are starting to really rev up right now. And it's just injected this kind of panic. And, when you look at the history here, I was pretty shocked when I saw the VIX close above 75. That's just pretty crazy.
Yeah, and I think what we have up here is this a daily. Oh no,
No, this is a monthly. This is pretty much all of the information we have on the VIX. So you can see these points in times, obviously, when you had the crashes or the beginning of some bear markets, that's when you started to see these spikes, but or actually, I should say near the end of those times. But
I'm wondering, because I know this is the new methodology. I had read an article that the VIX got up to 80 in November of 2018, but
oh yeah, I mean, maybe it's just the different way that it is calculated, but the main point is typically when we get these crazy readings, that's that time where you are tempted to reach out and catch that falling knife. So
that time, the previous historical precedent, it was not a buy signal. Got up above 80, so
right.
Keep that in mind.
And then this is my long-term chart, and I'm going to pass that. We'll look at the definition of capitulation, but I thought it would be nice to just get kind of a current temperature of what's going on, because it is, it does feel very difficult and scary. But what I thought I'd do is look at in the past, and these are rough percentages, it's just using the tool we have on StockCharts. But as you can see, when we've had these major bear markets, we're talking about losing about half the value of what's going on in the market. We're only at about 25, 27%. Previously that correction that we thought might be a bear market was only just about 20% drop. You can see the other correction we had back here, it was just less than 15%. These are kind of the areas of support that we're going to be watching most closely. And, having closed today on that S&P 500 at 2480, I know what I'm watching for, and a lot of people are, is that 2350 area. Hopefully to find some support there, which is right about here at that low we had from that correction.
Wow.
Yeah, it's pretty sobering. Yeah, so let's go ahead and look at that definition of capitulation, and then I know you have a pretty good chart you were going to share, Mary Ellen. So go ahead. You created this lovely chart. I'm going to let you speak to it.
Yeah. So in essence, we're going to be taking a look at what is called capitulation, and the primary reason is because at that the bear market in 2018 was ended by a day of capitulation. In essence, it's panic selling. It causes a dramatic decline in stock prices, and oftentimes that definition is down 10%. And we did, in fact, see that, I believe 9.99, but awfully close to that 10% on the Dow. And so capitulation is worth noting and knowing about because it often is near or below previous support levels. So at this point in time, Erin just showed us the chart. We are still about 10% away from that 18% low. We're not quite near that support level, but let me go ahead and I will share my chart, and then we can take a look at some other metrics, because again, capitulation can be the signal of a bottom in the markets, but you do need other characteristics. So what I'm sharing with you here is a daily price chart of the S&P 500. So I had it so that it includes that capitulation day back here, December 24th of 2018. I'm sure many of you were in the markets at that time, may well remember that the markets did hit a low, near-term low, and then actually advanced for the day on huge volume. The volume on that 24th, it was triple the average volume over the last 20 trading days. You'd have to go back to August of 2018, Black Monday, when the volume was as high as on this capitulation day. But let's take a look at some of the other metrics, the other indicators that were present during that capitulation. The first is we can see right at that December 24th, the RSI was really in an oversold position. Take a look, because we had just almost 3 weeks of down days successively, and the RSI did go ahead and enter into that oversold position. And then we also had this positive occurrence where the moving average convergence, divergence, MACD, these are both momentum indicators. We had that black line going up in positive fashion through the red signal line. So that is were some characteristics present that also indicated that this capitulation could well be the bottom. Now let's fast forward to where we are today. This is as of the close today. We can see the significant, actually it was 9.5% at the end of the day. But let's take a look. Your RSI is not quite in an oversold position. Also, we can take a look at this MACD and see that we are not in any position to have that positive crossover. So these are other technical indicators that coincided with the capitulation at the end of the most recent bear market that I did want to point out to you. So based on that evidence, despite potential capitulation today, we're not quite there yet. Europe, they did have the SOX 600, stocks, STOXX 600. That's the European market. They were down 11% today. Credit markets, they are calling capitulation there. You can look at some of the muni funds, VanEck Municipal Fund down. So we are seeing a potential capitulation in other areas of the market as well.
Yeah, it's pretty ugly out there.
Mhm.
But we are getting to some interesting support levels. I just on a quick aside before we go into break, I've been talking to others and of us that have, pretty much lived through those major bear markets we were just showing. And, most of us the discussion is that this really doesn't feel the same. And I think really it just comes down to, there's some serious unknown right here. There's panic over the coronavirus. Technically we needed a correction. I wasn't expecting a crash per se, but for me, I definitely feels different just because the focus is less on the financial aspect. As far as the fear goes, it's got a lot of health, issues. But financially right now, we're just looking at what's happening because of a virus, the cruise lines, et cetera, all of these areas being hit hard. But what is your perspective?
Yeah, so a couple of things relating to that. Number one is historically, this is the swiftest descent from peak in price to a bear market in history. So there's that element that is a bit unnerving, that we are just crashing through. The concept of support tends not to have as much of an impact given just the severe panic that we're seeing. But I would argue that the financial markets are actually the financial side. When I talked about the bear market, the capitulation in the municipal bonds, the sole reason there is because there is a sense that businesses are going to really be negatively impacted by the coronavirus, and hence taking it the chain a bit further, the municipal market, the municipalities are going to get less in the way of tax income. So people are taking that financial chain or train of thought a bit further currently, in addition to the fallout as far as health-wise.
Right,
So,
right. Yeah, it's definitely, from a distance, watching it is quite interesting. Of course, being involved in it can be a little less fun if you're holding onto a lot of positions. But
yeah,
at this point, we've got some really important support that we're getting ready to hit. you know, eventually, I mean, economically, fortunately, I think we're in a pretty good position as a country, but I think the fear of the unknown, really not knowing, well, how good of a position are we really?
Right. And when really containment is the key word. So once we get any kind of clues on ways that the virus can be contained, until then, this volatility is just going to be here to stay, unfortunately.
Yeah, absolutely. All right. Well, we're going to go into a break. We'll talk a little bit more about bear market rules and move into bear market trading per se. So stick around.
Hi, this is Mary Ellen McGonagle, author of the MEM Edge Report. In my biweekly report, I highlight top growth stocks as they enter buy zones, and I educate subscribers on why that stock is attractive both technically and fundamentally. In addition, you'll be alerted to when it's time to exit that stock based on negative technical action. And this biweekly report gives you confidence by providing fundamental insights into why an area of the market is strong and which companies within that strong area have the best growth profiles that'll help propel that stock higher. Subscribers to the MEM Edge report are benefiting from my expertise in uncovering top performing growth stocks. Subscribe now to take advantage of my special trial offer.
All right, we are back. We have just been talking about the current conditions of the market and capitulation. And it's time now. We want to talk to you a little bit more about those bear market rules. Like I said, I know we've been hitting these hard, but I think they're really important to think about. So let's go ahead and we'll look at that first slide. And these are the basics that we talk about at Decision Point as far as rules go. You know, overbought conditions, boy, I wonder if we'll ever see those again, but we're pretty far away from that. But if we do end up getting in that space because we get a rebound, we need to be careful. That's more than likely a time to expect, you know, more downside. You get a lot of people doing, like I know I have been, selling into strength. So, and then those short covers, that's been kind of messing with things. Oversold conditions, which is what we are definitely in, and that's that catch a falling knife thing. You know, it looks like, you know, we've hit these levels, oversold levels of extremes that we have, you know, that are historic in some cases. But, you know, if we do get a bounce, similarly to what we saw after that first drop, we had a couple days that were historically moving to the upside. It's thin ice, you know, so you get that bounce, you jump off of that thin ice, but it breaks under you. So when you come back down, you're in cold water. So something to consider. Buying into these conditions is extraordinarily dangerous. As most, you know, if anybody's been trying to do so, they probably understand that rule pretty well. And then, of course, we need to just start expecting bearish conclusions, not only to chart patterns, but really just, you know, when you're looking at the two sides, which one would you go for? Start thinking on that bearish side. And, you know, my dad had a great, he said something great recently in one of his weekly raps he writes on Fridays. So I'm going to skip to that quote, which is, I think, on our next slide. There it is. So my father, so while bear market rallies present great profit opportunities, so remember, you know, when we started to get those bounces, you know, they can prevent those great or present great opportunities. What I suggest, and a lot of people who follow me and a lot of traders are like me, those long and intermediate term positions, you need to be managing those in the short term. You got to put your hand on the wheel now, or completely step out, which is, you know, park the car, which is, I think, really where I'm at right now.
Yeah, it's very tough. I can tell you from my work, those of you not familiar, I worked with Bill O'Neill at, he's the founder of Investors Business Daily. And from his work, and certainly a lot of others, the bear market, you're thinking stocks are now cheap. I can get in now. and having lived through at least 2 bear markets, I can tell you, as we said in the beginning, that catch the falling knife, you're just not going to be paid if you in fact do that. And I know that there's a Dow theory out there that suggests anytime the market drops 5%, nibble, but my work says absolutely not. It's not a good time. So just
Yeah, absolutely.
as well.
You had a chart you had talked about earlier in the program. Would you mind showing us that?
Not at all. Yeah, let's go ahead and take a look. I'm going to be sharing with you a longer term view. It's going to go ahead and show some of those other bear market periods. Historically, it's a monthly price chart. This is the S&P 500. And so what I'm pointing out to you here with the current situation is that the December 2018 lows, and I know we talked earlier that support is not having quite as much relevance given the severity and the swiftness of the drop, but we are about 9% away from that. That is the next conceivable area of support. Generally, you are looking at your previous lows, but more to the point, let's go back and take a look at some other periods and other bear market periods in particular. This, of course, is the internet bubble into 2000, and it was not until 03 March that the markets did in fact emerge out of this bear market. But the other technical indicators we can take a quick look at is that the RSI did turn negative during this particular period here, in line with a break on the monthly. You'll want to use this 6-month simple moving average. And this was applicable for longer term investors with individual stocks as well. Takes out a lot of the noise, but we can see it also coincides with the stochastics, another momentum indicator, going below this dashed net neutral. So if we go back over to the 08-09 bear period, same characteristics, RSI, and also the stochastics actually were an early signal as far as turning negative. So if we take a look, the reason I had been focusing on this was with an eye toward a potential halting where we had corrections as opposed to bear markets when the stochastics remain above this net neutral. But sure enough, this week's action, we can see the stochastics are just now turning negative. This is as of yesterday. I put out a midweek report last night and we were still neutral. But today's action has pushed it into negative territory with the RSI. And of course, the action as far as the negative decline does indeed have us in a bear market territory.
Right. And one of the things I'm noticing there too, because this is part of my studies, but if you look particularly in the 08 period in the RSI and the stochastics, you can see how low they got, how oversold they were, and we're just not there. I mean, we could certainly see these indicators move much lower.
Continue to follow these because, of course, you want to be on the prowl for this bear market reversal, where quite simply just the opposite takes place. We emerge into positive territory on those stochastics, and then we can draw our eye up. The RSI, those stochastics, I like to use on longer term charts. They're going to be an earlier signal for you because we don't get the RSI positive for quite some time, but we do get an early signal as far as RSI emerging out of this oversold position. So you would want to maybe drill down to a shorter term time frame to get that RSI positive signal.
Absolutely. I want to just show one chart. I'm going to talk about it today in my DP alert, but it's a sentiment indicator. It kind of tells you what the big guys are doing. And right now we got some really interesting, it's the National Association of Active Investment Managers. So these are the big guys. And look at what we've had here. This is one of the lower readings we've seen as far as exposure goes, currently at just 16.5. We did see it move much lower though. Exposure levels we've seen get lower back here in 2014, but wow. It's a good idea to follow what they're doing. It kind of gives you an idea of, what to look for and what to consider.
Very good.
All right. So yeah, that happened. There's a lot of things right now. We could say, yeah, that happened.
Well, I have to say, in closing all of my windows, I don't have the actual article. It was out of Barron's, and it talked about how in China, because they are the precursor with the coronavirus, they are seeing reduced cases. So this article had to do with how incredibly popular
There we
food.
go.
Oh, you're wonderful.
You know.
Yes, food delivery. So takeaways are beating dining out. China grinds slowly back to life. And there's another, by the way of economists are telling that these Chinese factories are starting to fire back up, and it is because they're looking at global, oh my gosh, what is pollution? The pollution. But more to this article here is this concept that takeout is really on a roll. China also has a ruling. They're only allowing individuals to, if they do go out to eat, you can only sit at a table with a two-guest occupying rule. You cannot have 3 people at a table, and there's also a distance rule as well. So while cases are being reduced, they are still being very vigilant as far as should you decide to go out to eat. But more to the point, there were a couple of stocks that we could certainly take a look at given this concept as far as food delivery. Let me go
ahead and
share my chart here. And what you'll see is there are a couple of stocks that are holding in well. This first one actually did just come out with very strong numbers recently. This is Domino's Pizza, DPZ is the ticker. This was their big earnings, and we can see this is a weekly price chart. It really, by and large, is defying what is going on in the rest of the market as far as really withstanding the downward pressures. Some of the other delivery services are not faring as well, although Postmates, they are not public, but they did announce that they are seeing record high for their services. They deliver more than just food, so people just don't want to go out. This is Grubhub, one of the more popular food delivery services, and we can see it is down 16% today. It's certainly not a good example, but McDonald's is suffering as well, but they just signed up with Postmates. This is a daily price chart, not a pretty chart by any means, but certainly of interest. Erin, I don't know if you have a stock to.
Oh, yeah. Let's see. I think Amazon, we were talking about that one. I know a lot of people look at that chart, but there's certain areas I have to say, that you may see, better action from, just because of the fact that they are mail order or things where you don't have to leave. But I think Amazon, you can see that it's having some big problems. We had that intermediate term trend model neutral come in with 20 crossing below that 50. So, you've got warehouses though with people who work in them and things like that. So you just have to be really aware of what the industries are, what they're doing.
But KR had been a real darling going into today, and they dropped certainly a lot less than the broader markets, but Kroger is a renowned supermarket, and with an eye toward people hoarding, we talked about this last week, water and toilet paper and all kinds of amenities. My husband went to the market today and had to wait a long time to get a shopping cart.
Yeah.
So it's still very alive and well. And there's
Oh, we've got to close out. I do want to thank everybody for watching today. Stay safe, stay healthy, and hopefully we'll see you next week.
Take care.